Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Friday, December the 19th, 2025. Just an administrative note, as we're going into Christmas, this might be the last one going into to Christmas, so we're going to take a break for a few days with the Macro Snapshot. But let's immediately look and see what happened overnight. Probably the biggest thing which happened overnight was the Bank of Japan. Now, as expected, they did hike by 25 basis points. But as you can see here, let's look at a bit of a market reaction. You can see here a big green candle in the Japanese 10-year government bond. That's the 10-year yields here going up above 2%, which is the highest it's been for a long time. I don't know. I'd have to actually go back and check. But you can see here that this has been just sort of one-way traffic going upwards. So that's putting upward pressure there on the yields, which is going to have a spillover effect for sort of potentially for other developed markets, for example, like Germany and the US. But what is interesting here is the reaction of the Japanese yen, which was actually fairly sort of dovish in the sense that the Japanese yen weakened significantly against the US dollar. So if we actually have here a look at the US dollar, you can see the US dollar, which in general, I have to say, has been sort of breaking a bit higher over the last few trading sessions. But you can see here, big green candle up sort of over, it looks like up over 1% or so. So the next levels here are going to be testing 157.8, that recent high. And then the big one is going to be at 159. There could be some danger of intervention by the Ministry of Finance at that point because the problem here is that with the Japanese yen weakening, that is going to make imports more expensive, which is inflationary. And keep in mind that the new government of Takeichi very concerned about inflation. She's been giving sort of subsidies for energy and other things, and very concerned about the cost of rice over in Japan. So the point is here is that potentially I think it's not too much of a stretch to see USD, as I say, up to test these recent highs at 157.8, but 157.9 could be an interesting place for a speculative short. So what happened? Why are the yields going up, and why is the yen sort of weakening here? And it's interesting because despite the fact that they hiked, the forward guidance was quite neutral. The market was I don't know, I guess expecting some sort of sense that another hike would be coming maybe in the first half of 2026. But Ueda, in his press conferences, essentially said that he would need to monitor the effects of this hike, and keep in mind that it took them, I think, like 9 months between last night's hike and the previous hike. So the market is immediately thinking, "Oh my God, he's going to be looking at the situation for another 6 or 9 or 12 months or so." So it was a much less hawkish hike than anticipated. I mean, they did say that they did expect inflation still to reach their targets. Basically, inflation is still a little bit sticky. In the press conference and the statement, the BOJ said that they expect wage growth pressures to continue to go upwards. So it's like just this very slow kind of path. On the other hand, he did say that real interest rates remain significantly negative, and that's the interesting thing here. So even though we saw the 2-year rate is at the 10-year rate is at 2%, inflation is around about 3%, and we got actually the November CPI numbers out of Japan last night. So inflation is still above, let's say, the 10-year rate, so it's still significantly negative, and that was something which was pointed out by Ueda as well. So the fact that this real interest rate remains negative is still quite accommodative, which of course is politically very palatable. So Takeichi could say, well, okay, they hiked interest rates, but on the other hand, they're still not as high as inflation. So therefore, the Bank of Japan's interest rate is still supportive of the economy, is still accommodative in a certain sense. So the idea here is that if that's the case, presumably there's more room for hikes, and that's what Ueda said. But he just said, "Hey, I need to see how this all pans out," and he didn't give any specific forward guidance about the next probable date for an interest rate hike. And I think this is why the Japanese yen has sort of sold off in disappointment that we could be in for a 6 or 12 month sort of wait. And as I say, Ueda was very vague about the neutral rate and the future path. So at this point, that's where we're at with the JPY. It looks as though probably the best thing to do is just to let this sort of get up to that level, and then of course all the talk about speculation will come in. Just while we're talking about bond yields and whatnot, pretty interesting to see what's happening in the German space. So if we look here at the 2-year yields, not too much of a change, but as soon as we get out into the 5, you can see see a bit of a red candle. And then especially look at the 10-year yields up significantly in Germany. Also the 30-year really ripping a lot higher. So we've got a bear steepening there of the curve. Just quickly as well, we can see that Italian yields, which are normally quite well behaved these days, also up quite a lot, and about 30, and then also the French yields up quite a lot. So that could be on the idea that basically there are a lot of talks, diplomatic talks yesterday in Europe, and they've agreed. When I say they, the European sort of Union, in a sense, has agreed to issue joint debt, so to federalize the debt to the tune of about 100 billion euros to help fund Ukraine, essentially. So, without going into all the political details, essentially more joint debt issuance all across the Eurozone here. And of course, at the end of the day, this is not necessarily great news for Germany, because a lot of the countries with higher debt to GDP ratios like Spain or Italy, they're the ones who tend to sort of benefit on a relative basis compared to a country like Germany. So anyway, the point is that a lot more sort of debt being issued. I mean, not an enormous amount to sort of, to collapse economies or something, but I think that's being reflected here in the yields of things like the French debt, and you see the German 10-year yields, and as I said, the 30-year yield on the books all really going up quite a lot, just to sort of accommodate that extra debt issuance, which is pushing the yields higher. Now, is this a good thing for the euro? Not necessarily. I mean, let's just, while we're here, have a quick look at the US and see the reaction. You're seeing that the US 10-year yield up a bit, and if we look at the 30-year yield up, a little bit more at the front end of the curve, as you can see, not too much. So again, a little bit of bear steepening in the US space as well, but not as significant as Europe. So just in terms of the currencies and the effect of that, you can see if we can find the euro. Sorry, let me just find the euro USD. The other thing to keep in mind, talking about Europe, just looking at the euro USD here, is you see the euro not really benefiting from that high yield, and we're starting to get into those dynamics, which we've seen, quite a lot in the UK, but also in the eurozone, of this increased government sort of spending, fiscal sort of lack of discipline, plenty of debt being issued, and the currencies are not really loving that. They're saying, well, okay. It's not sort of a simple question of higher yields, therefore that's going to sort of push the local currency higher. It's in fact the opposite. We're getting into this dynamic of a market being concerned by the higher yields and extra too much debt issuance, which is actually causing the local currency. You see here the euro USD to actually sort of weaken somewhat. It's probably also just in the back. Yesterday we had the ECB meetings. I won't go into too many details. That was fairly neutral. The growth forecasts were revised upwards a little bit. Inflation remains at a level with which the governing council seems relatively sort of comfortable, but they did say that they could move both ways, to say like a hike potentially or a cut. So very much sort of a neutral meeting, data dependent, et cetera, et cetera. Nothing much to say there. So we have the euro just falling a little bit here. Other thing just want to keep an eye on here is the British pound. Now we did have a cut yesterday from the BOE as well. What was interesting, there was a bit of a fluctuation you see here on the daily, sort of unchanged, kind of like a doji here, a candle. But you can see here that the pound might be, it hasn't completely fallen really, and that was possibly because in the press conference it was a little bit more. So not the press conference, there was the press release, so kind of like the statement released, and that was a smidgen more. Sort of hawkish than the market had potentially anticipated, essentially saying that inflation was structurally sort of higher than they really wanted. And also there was some concerns voiced in the statement about wage growth not sort of moderating, and the potential for wage growth to continue going higher. So that's probably kept the British pound from falling too much more. I guess we'll see next year with the data, going into 2026. In terms of other markets, what we have seen is the precious metals remaining bid. Let's have a look at gold here. Gold, it's not doing a huge amount, but it's certainly not falling at any point. Didn't quite test the recent highs on the futures, but if you actually look on the spot price, you can see that we did actually test on the spot price basically the recent highs up at about 43.85 or so. So gold still looks quite good. On the other hand, we have silver, which looks as though it wants to have a big push. And just look at this price action. At the end of the day, well above all the moving averages. You see we're only getting 1 or 2 days of consolidation. You see 1 or 2 days, 1 day, red candle. Even back here, we only had 5 or 6 days. The first fib level was brought up strongly. So it looks to me as though silver potentially wants to push higher. And then if you look at things like platinum here on the ETF as going out to new highs, you look at the pre-market on this ETF, up a little bit higher as well. Palladium, breaking out higher, although that's starting to get into, sort of profit target zones like measured moves on the Fibonacci's. But the precious metals moving well, and then doing a bit of catch up. Just want to look at here at copper, big, big, big strong candle. This is significant technically because there's been resistance, quite a lot of resistance at the 61.8% fib. This is the high grade contract, so this is a US contract here. But you can see here, this is the first decisive push higher above that 61.8% retrace level at 5.52. So this to me looks as though, let's see what happens. But assuming that this is not some kind of just little push above, spike above, this is going to be quite an important day because if the bulls can hold this, you have to expect this to maybe push up significantly higher, maybe to 5.75 or so. On the other hand, if the bulls cannot hold it within the next, let's say, 4 or 5 trading hours, here we are sort of on Friday morning, going before Christmas, so to speak, liquidity is going to thin out. It's going to be interesting. That could just sort of come back and be a false breakout. But if it doesn't come out and there is a little bit of a push in thinning liquidity, holiday liquidity, we could see our copper significantly higher. So that's an interesting one to keep an eye on. But basically, all the metals, precious and semi-precious and industrial, seem to be doing pretty well. Finally, just a quick sort of word about the CPI. CPI came in yesterday. So I'm just going to grab some tea here. CPI came in fairly soft, and the market quite liked it. But you can see there was a lot of concern once we started digging into the numbers. Just looking at the reaction here of the bonds, you can see here there wasn't a huge reaction in the ES. You see the mini futures here up a little bit, but gave a little bit back. I mean, this is fairly choppy price action at this point. Nasdaq up a little bit more, a little bit stronger. But basically, just in terms of the CPI, yes, the headline numbers, the core numbers, everything looked pretty good, moderating inflation. You can't really argue with that. Although digging into the numbers, it was interesting that it seems as though with the lack of sort of totality of data, that some of the numbers were essentially zeroed, put to zero. It's like, hey, we don't exactly have that number, so let's just give it a zero number. Especially there was some concern about sort of the owner equivalent rent and some of the lodging, sort of for accommodation, housing kind of prices. So that's an interesting one. And I just wonder whether the market is saying, hey, this data is not 100% accurate, it's not 100% reliable. We'll put an asterisk or a question mark on that because if you look at the bond market in the US, I mean, to be fair, you can say that initially you see here there was an initial spike in the 2 year in the price, so that means the yield's going down. But as you can see, there wasn't a huge amount of follow through. So if you look at the front of the curve here, which ordinarily one would have expected to really have had a fairly bullish reaction, it did initially have that, but it did give it back. Quite a lot was given back, and then the further out the curve go, you see that actually sort of into negative in terms of the prices here. So yields are higher, on the 10 year, and then you go on the ZB, so the 15 to 20 year, you can see that had a pop and drop, so to speak. So I think the market is still a little nervous about inflation. I think the general tendency seems to be, hey, it is sort of moderating somewhat, but it's the question around the somewhat which is preventing the front end of the curve from really ripping higher, and those yields are falling in a sustained way. We'll keep a lookout for that. And all that to say that I think that is supporting, you can see the US dollar here being supported just because the US dollar, again, one ordinarily on falling inflation, higher expectations for the Fed to be a little more dovish. But you can see here that again was sort of a drop and pop rather than the pop and drop. You see the dollar index here initially went down in those numbers at 8:30 yesterday morning, but subsequently have pushed higher. Although, of course, quite a big chunk of this is a reflection of Japanese yen weakness. Nonetheless, it does seem that just in terms of the FOMC, that we still do have a market that's pricing in 2 cuts for 2026. First cut by sometime, up to April, and the second cut sometime by September of 2026. So the market is still comfortable with that, but doesn't want to get too much more dovish just until and unless I think we get a bit more clarity on the situation with inflation data. Okay, guys, as I say, I'm going to sign off here just for a few days, probably take a little break until Christmas. Probably we'll be back with the macro snapshot between Christmas and the New Year for 2 or 3 days. And then, of course, we go into 2026. So thank you. Have a wonderful sort of holiday break. and we'll see you in a few days. Take care and have a great day. Thank you.